Welcome to Talk Tickers.
It's good to be here.
Today we're tackling a topic that it really sits right at the intersection of tax law, retirement planning, and maybe most importantly, portfolio efficiency.
That's right.
It's a mechanism that sounds like a loophole, and maybe 20 years ago it sort of started as one, but as of 2026, it is arguably the single most critical strategy for high net worth investors to understand.
It really is. We are talking about the difference between a portfolio that suffers from what we call tax drag every single year versus one that compounds completely, unencumbered by the IRS.
It's the difference between a taxable legacy and a tax-free one, and that's a huge distinction.
It is, and it's one of those terms that gets thrown around constantly on, trading desks and in wealth management offices, the backdoor Roth, but the gap between knowing the term and actually executing the trade without triggering a tax nightmare is surprisingly wide.
That's what we're digging into today,
Okay.
because the stakes here are very real. We aren't just talking about saving a few bucks on a tax return.
No, not at all.
We are talking about creating a tax-free legacy bucket that avoids RMDs, lowers your Medicare surcharges down the line, and provides pure liquidity when you need it.
And tax drag, which you mentioned, is the silent killer of compounding. I think most high earners assume they are simply locked out of the best tax-free growth vehicles like the Roth IRA just because their income is too high.
Right. They see the income limits published by the IRS, they see the phase-outs, and they just stop reading.
They assume the door is completely shut for them.
But the reality is, while the front door to the Roth IRA is, in fact, locked by the IRS for high earners, the back door is wide open.
Wide open. And it is fully legal. In the current regulatory landscape of 2026, it is, for all intents and purposes, sanctioned by Congress.
And this is a massive, but you have to know where the landmines are.
Specifically, something called the pro-rata rule. If you step on that, you can blow up the entire strategy.
Instantly.
You turn a tax-free maneuver into a taxable event, and you create a paperwork headache that can literally last for decades.
So that is our mission for this deep dive. We're going to break down the backdoor Roth IRA conversion piece by piece. We're going to look at these specific 2026 contribution limits and the income phase-outs.
We'll strip down the mechanics, how to execute this two-step trade without setting off alarm bells at the IRS.
We will dissect that pro-rata rule so you don't get burned, and we'll compare the backdoor Roth directly against a standard taxable brokerage account to see if the administrative squeeze is actually worth the juice.
It's all about the mechanics, the traps, and the powerful math of tax-free compounding.
Okay, let's start with the basics. The problem: why do we even need a backdoor in the first place? Why can't a high earner just log into their brokerage account, click Open Roth IRA, and, just deposit the money?
It all comes down to the income limits set by the IRS. Now, the Roth IRA is, it's arguably the gold standard of retirement accounts.
No question.
You put money in, it grows completely tax-free, and crucially, it comes out completely tax-free. Plus, and this is huge for estate planning, there are no required minimum distributions or RMDs during the owner's lifetime.
That's a massive benefit compared to a traditional IRA or a 401k, where the government basically forces you to start taking money out in your 70s, whether you need it or not, and pay tax on it.
Exactly. But the IRS puts a velvet rope in front of that gold standard account. They don't want the ultra wealthy or even, frankly, the moderately wealthy stuffing unlimited amounts of money into these perfect tax-free shelters.
So they set up these income phase-outs. If your modified adjusted gross income, or MEI, is too high, you are just prohibited from making a direct contribution.
Correct. And for 2026, those numbers are pretty strict. When we say MEI, it's important to remember we aren't just talking about your salary. We're talking rental income, dividends, interest. It all stacks up to get to that number.
So let's look at the 2026 numbers specifically. If you are a single filer, where does the trouble start?
For single filers in 2026, the phase-out, it begins at $153,000 of MAGI.
Okay.
If you earn between $153,000 and $168,000, your ability to contribute is reduced. It scales down. And once you hit that $168,000 mark, you are completely locked out. You cannot put a single dollar directly into a Roth IRA.
$168,000. I mean, let's be realistic. In a coastal city, for a mid-career professional, That is a very achievable number.
Well, absolutely.
It's not private jet money, it's senior manager money.
It really is. And for those married filing jointly, the phase-out starts at $242,000. You are then completely locked out at $252,000.
So if a household has two professionals, let's say a nurse practitioner and a software engineer, they are very likely blowing past that $252,000 limit.
Easily. For many attending physicians, corporate executives, mid-career professionals, business owners, that threshold is essentially a speed bump. They cross it without even realizing it until tax time rolls around.
And it creates what many people view as a tax penalty for success. You earn more, so you lose access to the most efficient tax vehicle available to the average person.
Right.
But the tax code is a fascinating document. It's a series of layers. While one layer says no direct contributions, another layer says something else entirely.
And that's the whole nuance of this. While the code says if you make $300,000, you cannot contribute to a Roth, a different section of the code says, conversions are allowed regardless of income.
And that is the back door.
That's it. Correct. The backdoor Roth isn't a specific type of account you sign up for at your brokerage. You don't go to the bank and ask to open a backdoor Roth.
The teller would have no idea what you're talking about.
They'd look at you blankly. It is a strategy. It's a transaction. It's a process.
Okay, so it relies on two distinct features of the tax code. Let's unpack those features because I think understanding why this works really helps you understand how to do it correctly.
Okay, feature number 1. There are income limits on deductible traditional IRA contributions and direct Roth contributions. We've already established that. But, and this is the key, there are no income limits on non-deductible traditional IRA contributions.
Wait, okay, clarify that. Non-deductible. What does that mean in practice?
So normally people put money into a traditional IRA to get a tax break today. They contribute, say, $5,000, and they deduct that $5,000 from their income on their tax return.
So they pay less tax this year.
Exactly. But if you make too much money, the IRS doesn't allow you to take that deduction. However, and this is the critical part, you are still allowed to make the contribution, you just don't get the tax break for it.
So anyone, regardless of whether they make $50,000 or $5 million a year, can put money into a traditional IRA as long as they classify it as non-deductible.
Correct. You don't get the tax break up front, but you can put the money in. That's step 1. Then, feature number 2, there are no income limits on Roth conversions.
So, to use an analogy, I can't walk through the front door of the Roth party, but I can walk into the room next door, the traditional IRA room, and then simply ask to be moved over into the Roth room.
That is the perfect analogy. You enter the building via the traditional IRA room. The bouncer at the front door checks your ID and says, you can come in, but you don't get a drink ticket. That's the lack of a tax deduction.
Right.
But once you are inside that room, there is a connecting door to the Roth party. And the bouncer at that door doesn't care about your income. He just cares that you pay any applicable taxes on the move.
But because you already paid taxes on the money, remember, it was a non-deductible contribution. There's theoretically no tax cost to move it from the traditional room to the Roth room.
Exactly. You already paid the cover charge to get into the building. You don't have to pay it twice just to switch rooms.
So let's talk numbers for 2026. How much capital can we actually move through this mechanism?
For 2026, the contribution limit is $7,500 per person. If you are age 50 or older, you get what's called a catch-up contribution, which brings your total to $8,600.
And since IRAs are individual retirement arrangements, a married couple can effectively double this, right?
Absolutely. If a married couple is both over 50, that is $17,200 of tax advantage space they can create annually.
Now, $7,500, that might not sound like a life-changing amount to someone making, say, $400,000 a year.
No, it might not.
But over 10 or 20 years, that is not a trivial amount of capital, especially when you consider that every penny of the compounding is happening completely tax-free.
That's where the power lies. It's the long-term compounding effect.
Before we get into the how-to, I want to touch on the history of this, because for a long time, there was a lot of nervousness around this strategy. People felt like they were getting away with something. It felt a little sneaky.
It did. There was legitimate fear among tax professionals regarding the step transaction doctrine.
What is that?
It's a legal theory where the IRS can look at a series of separate legal steps and say, hey, you didn't really mean to do step A and then step B separately. Your intent all along was to get to the result of step C. They could claim that the two separate legal steps, the contribution and the conversion, were effectively one illegal step. A direct contribution by a high earner.
I remember hearing stories about advisors telling clients to wait. They'd say, put the money in the traditional IRA, let it sit for 30 days, maybe 60 days, let it gain a little interest, then convert it.
Yes.
They wanted to make it look like two separate decisions. Like, oh, I just happened to change my mind about my investment strategy a month later.
That was the old playbook. It was all about risk mitigation. We were trying to put some daylight between the steps so the IRS couldn't come back and claim it was one immediate pre-planned transaction.
So what changed?
The landscape has shifted significantly. The Tax Cuts and Jobs Act of 2017 included footnotes and congressional reports that effectively acknowledged and, sort of blessed the strategy. The IRS has largely signaled that the back door is a sanctioned maneuver.
So that step transaction fear is dead.
For this specific strategy, yes, it is largely considered dead. And in fact, the current best practice in 2026 is the complete opposite of that old advice. We now call it the Roth wash. You want to convert it immediately.
Okay, why the rush now? If the IRS doesn't care, why not let it sit for a bit?
Because of the math. If you wait and that money sits in the traditional IRA, it might earn interest or dividends. Let's say you contribute your $7,500 and you leave it there for a month. Even in a simple money market fund, it might earn $30 or $40 of interest.
And that interest is pre-tax growth.
Right. You haven't paid tax on that $30 yet. So when you finally convert the account, you have $7,500 of post-tax money, your basis, and $30 of pre-tax money, the earnings.
And you have to pay tax on the $30.
Right. Exactly. It's not a lot of money, but it creates paperwork friction. You have to calculate it, report it, and pay, maybe $10 or $12 in tax. It's annoying. You want to contribute and then convert as fast as the settlement period allows, usually 24 to 48 hours, to avoid any growth whatsoever in the traditional IRA.
You want a clean conversion where the taxable amount is zero.
Zero. That's the goal.
And speaking of the regulatory landscape in 2026, we have to mention the Secure 2.0 Act. Because this year, 2026, is really a pivotal year for high earners because of this concept of Rothification.
This is a huge philosophical shift in retirement taxation. Under Secure 2.0, starting in 2026, if your wages from the prior year from 2025 exceeded $150,000, you are no longer allowed to make pre-tax catch-up contributions to your workplace 401k.
Okay, what does that mean?
It means those catch-up contributions for people over 50 must be designated as Roth contributions.
Wait, so the government is forcing high earners into Roth? I thought they wanted to keep us out of Roth accounts.
It's a bit cynical, but it's very practical from their perspective. The government runs on a deficit. They want the tax revenue now, not in 20 or 30 years when you retire. By forcing you to make Roth catch-ups, they collect the tax on that income today.
So they are effectively saying, we love Roth as long as you pay the tax up front.
Precisely. And the implication for you, the investor, is that the government is pushing you toward tax diversification. The Backdoor Roth IRA aligns perfectly with this legislative push. If you're already being forced to do Roth catch-ups at work, adding a Backdoor Roth IRA just creates a more cohesive strategy for building tax-free assets.
It's like the government is showing its hand. They want revenue now, so take advantage of the tax-free growth they're offering you in exchange.
That's a great way to look at it.
Okay, let's get into the practical mechanics. I want to walk through the happy path. This is the clean execution for an investor who has zero existing traditional IRA balances. They're starting with a completely clean slate.
This is the ideal scenario. It's the simplest, cleanest execution. Step 1. You contribute $7,500 of your after-tax cash to a traditional IRA. You designate this as a non-deductible contribution. Most brokerage platforms will ask you about this, or you just simply decline to take the deduction when you file your tax return.
And crucially, do you invest that money right away? Do you buy an index fund or a stock with it?
No. Absolutely not. You leave it in cash, leave it in the money market or the settlement fund.
Why is that so important?
Because markets move.
Yeah.
Imagine you buy $7,500 worth of a stock. 2 days later, it jumps 10%. Now your account is worth $8,250. When you go to convert, you owe ordinary income tax on that $750 gain.
You've created a taxable event.
Instantly. Or worse, it drops 10%. Now you only have $6,750 to convert, and you've effectively wasted some of your precious contribution space for the year. You don't want any market fluctuation during the transfer. You want stability.
Okay, so the $7,500 is sitting there in cash. What is step 2?
Once those funds settle, which is usually a day or two, you execute a Roth conversion of the full amount. You just instruct your brokerage to move that $7,500 from the traditional IRA to the Roth IRA.
And the result of that transaction?
You now have $7,500 sitting in your Roth IRA. Since the contribution was non-deductible, meaning you already paid income tax on that money before you put it in, and since there was no growth because you converted it immediately, the tax bill on the conversion itself is zero.
Getting that.
Then, once the money is safely inside the Roth IRA, you invest it. That's when you buy your ETFs, your stocks, whatever your long-term strategy dictates. From that moment forward, all the growth, all the dividends, it's all tax-free.
It sounds so simple when you lay it out like that. Deposit, convert, invest.
Yeah.
But if it were always that simple, we wouldn't need to do a deep dive. There is a trap, a massive landmine that blows up this entire strategy for unknowing investors.
The pro-rata rule.
This is where the horror stories come from. I want to spend some real time here because this is the single biggest reason people either avoid the strategy or, worse, mess it up completely.
The pro-rata rule is the IRS's way of preventing you from cherry picking.
Cherry picking, what do you mean?
Meaning you cannot say to the IRS, hey, I have this big pot of IRA money over here. Some of it is pre-tax from an old 401k, and some of it is this new after-tax money I just put in. I just want to move the after-tax part to my Roth.
They don't let you do that.
No. The IRS does not view your IRAs as separate accounts with separate tax characteristics. They view all your non-Roth IRAs as one single aggregated bucket of money.
Aggregated. That is the key word, isn't it?
Yes. This includes traditional IRAs, rollover IRAs, SEP IRAs, and simple IRAs. The IRS essentially ignores the account numbers and the brokerage firms and looks at the total balance across all of them.
Crucially, what does it not include? Because this is our escape hatch later on.
It does not include 401ks, 403bs, or other qualified workplace plans. This distinction is absolutely critical. But for the pro-rata calculation, the IRS only looks at anything with IRA in the name, except for the Roth itself.
Okay, give us the formula. How does the IRS calculate the tax if you have other IRA money floating around?
The formula is your total pre-tax IRA assets divided by your total IRA assets. That percentage that you get is the portion of your conversion that is deemed taxable.
It sounds a little abstract. Let's run the disaster scenario to make this really concrete. Let's invent a listener. We'll call him Mark.
Okay, let's look at Mark.
Yeah.
Mark is a smart guy, makes good money. He has a rollover IRA from an old job. He worked at a tech startup for 5 years, left the company, and rolled his 401k into an IRA. It has $93,000 in it. That is all pre-tax money.
So Mark has this $93,000 sitting in a Fidelity or Vanguard account. Now he hears about the backdoor Roth strategy on a show like this, and he wants to do it.
Right. So Mark goes and opens a new traditional IRA, totally separate account number, maybe even at a different brokerage, and he contributes $7,000 of non-deductible after-tax money into it.
And Mark thinks, okay, I have account A with $93,000 of pre-tax money, and I have this brand new clean account B with $7,000 of after-tax money. I will just convert account B.
Mark is about to step right on the landmine. The IRS looks at Mark and sees one bucket. They do not see account A and account B. They see Mark's IRA bucket.
So they add it all together.
They add it all together. The total pot is $100,000. That's the $93,000 plus the $7,000.
Okay, I'm with you.
Now, of that $100,000 pot, 93% of it is pre-tax money. Therefore, the IRS dictates that 93% of any distribution or conversion from any of Mark's IRAs is taxable.
So Mark goes to convert his $7,000. He thinks it's a tax-free move.
He thinks so. But the IRS comes back and says, Mark, you can't just scoop the cream out of the coffee. That's the analogy we use. Once you pour the cream, the after-tax money into the coffee, the pre-tax money, it's all mixed together.
You can't separate it with a spoon.
You can't. When Mark converts $7,000, he is taking a sip of the entire mixture, and 93% of that sip is coffee. It's pre-tax.
So 93% of his $7,000 conversion becomes taxable income for that year.
Exactly. Roughly $6,510 is added to his taxable income for the year. He pays ordinary income tax on it at his highest marginal rate. Only the remaining 7%, about $490, is actually tax-free.
That completely defeats the purpose. He's paying tax on money he basically just put in.
Totally. He generated a significant tax bill on money he intended to move tax-free. And it actually gets worse.
How can it get worse than that?
He now has basis stuck in his traditional IRA. He still has after-tax dollars mixed in with his pre-tax dollars in that big bucket. He has created an accounting nightmare that he has to track on Form 8606 every single year until he finally empties the account. It is messy, it is inefficient, and it is costly.
He's effectively polluted his own IRA.
That's a perfect way to put it. He's polluted his clean after-tax contribution with pre-tax restrictions.
There's another really sneaky nuance to the pro-rata rule that catches people out. It's the December 31st snapshot.
Oh, this is a killer. It's so important to understand. The IRS calculates your total IRA balance for the pro-rata rule as of December 31st of the year you do the conversion.
What does that mean in practice? How does that trip people up?
Okay, let's say Mark is smart. He realizes he has this $93,000 IRA. He says, okay, I'll empty it. I'll roll it into my current 401k in January. Then in February, with a zero balance, he does a clean backdoor Roth. He thinks he's in the clear.
Sounds like he did everything right.
But then, maybe in November of that same year, he changes jobs. And he rolls his new 401k back into a rollover IRA.
So on December 31st, he has a pre-tax IRA balance again.
Yes. Even though his IRA was completely empty back in February when he did the actual conversion, if there is pre-tax money in any of his IRAs on December 31st, the pro-rata rule applies retroactively to the conversion he did 10 months earlier.
That is brutal. It's like a ghost haunting you from the future of that same tax year.
It is. The rule is you have to ensure that on December 31st of the tax year of the conversion, your aggregate traditional, SEP, and simple IRA balances are zero.
Okay, so the pro-rata rule is the enemy. But you mentioned an escape hatch. How do we fix Mark's situation? How do we unmix the coffee and the cream?
If you find yourself in Mark's position, or if you know you have any pre-tax IRA money, you have to clear the deck before you attempt the backdoor Roth. You need to get that pre-tax money out of the IRA bucket and into a different kind of bucket that the IRS doesn't look at for this rule.
And the number one strategy for that is the reverse rollover.
This is the most common and elegant solution. You take that $93,000 of pre-tax IRA money and you roll it into your current employer's 401k or 403b.
Now, can everyone do that? I thought rollovers usually went from a 401k to an IRA, when you leave a job.
That's the common direction for sure. But most modern 401k plans, especially at larger corporations, allow for incoming rollovers from IRAs. You have to check with your plan administrator.
So you just call HR or the 401k provider.
Exactly. Call them up and ask the magic question. Does my plan accept incoming rollovers from traditional or contributory IRAs?
And why does this work? Why does moving the money to the 401k solve the pro-rata problem?
Because, as we noted earlier, qualified workplace plans that 401ks are excluded from the pro-rata calculation. The 401k is like a fortress. The IRS's pro-rata rule cannot see inside it. Once that $93,000 moves into the 401k, it effectively disappears from the IRS's view regarding the IRA aggregation.
So the traditional IRA balance hits $0.
Exactly. The deck is cleared. Now, Mark can contribute his $7,000 non-deductible to his now empty traditional IRA, convert it, and since the total IRA balance is just that $7,000 of after-tax money, the conversion is 100% tax-free.
That is brilliant. It uses the specific definitions of the accounts to isolate the bases. It filters the coffee out of the cream, so to speak.
It really is. And frankly, a lot of 401k plans have gotten much better over the years. Lower fees, better fund selection. So moving your IRA into your 401k isn't the penalty it might have been a decade ago.
What if you are self-employed? You don't have a corporate 401k to roll into. You're a freelancer, a consultant, a small business owner.
Then you can open a solo 401k. If you have any self-employment, income consulting fees, a side hustle, selling things on Etsy, anything that generates a 1099 SLA, you can establish a solo 401k.
And that achieves the same goal.
The exact same goal. It allows you to do a reverse rollover of your pre-tax IRAs into the solo 401k, clearing the deck for a clean backdoor Roth. And solo 401ks are incredibly powerful for other reasons too, with massive contribution limits. But for this specific purpose, they act as the perfect hiding spot for that pre-tax money.
Okay, what if you don't have a 401k that accepts rollovers? Maybe your plan is old or it's a small company and they just say no. Yeah. Is there a nuclear option?
There is. The nuclear option is to convert everything.
You mean convert the $93,000 of pre-tax money too?
Yes. You just bite the bullet and convert the entire $100,000 to Roth.
But that triggers a massive tax bill.
It does. You would owe ordinary income tax on the full $93,000 in that tax year. For most high earners, this is not recommended because it could push you into an even higher tax bracket. You might be paying 37% or more on that money.
So when would you ever consider doing that?
It's rare, but it can make sense if you happen to be in a strangely low income year. Maybe you took a sabbatical to travel, you went back to grad school full time, or you're launching a new business and have zero income for the first year.
So you have room in the lower tax brackets.
Exactly. You might have room in the 12% or 22% brackets to convert that $93,000 much more cheaply than you could later in life. It clears the path for clean backdoor Roths for all future years. But you have to run the numbers very, very carefully. Do not do this blindly.
Let's talk about other common mistakes. We've covered the pro-rata rule, which is the big one. What else do people consistently mess up?
A very common panic moment involves spouses. I often get the question, my spouse has a huge rollover IRA from an old job. Does that screw up my backdoor Roth?
Because you file your taxes jointly, so you assume everything is combined.
Right. But the I in IRA stands for individual. Your spouse's IRA balances do not affect your pro-rata calculation and vice versa. You file taxes jointly, but the pro-rata math is done on an individual by individual basis.
So one spouse can have a messy IRA situation. Maybe they have a SEP IRA they can't move, and the other spouse can have a clean slate and do a clean backdoor Roth with no issues.
That's exactly right. It's a huge relief for many couples. You don't both have to be perfect to make it work for one of you. Treat the accounts as separate silos for this calculation.
Another mistake is confusing the backdoor Roth with the mega backdoor Roth.
Yes, we'll touch on the mega backdoor in more detail later, but they are completely different beasts. Different limits, different mechanics, different rules. Don't conflate them. If you Google backdoor Roth limits and see a number like $69,000 or $72,000, you are looking at the mega backdoor. The standard backdoor is limited to the standard IRA contribution limit, that's $7,500.
I'm going to pivot now to the paperwork, because this is where the strategy moves from theory to compliance. And there's one specific form that stands between you and potential double taxation.
Form 8606. It is arguably the most important tax form that most people have never even heard of. If you use TurboTax or you have a CPA, you need to verify that this form exists and is correct in your return.
What is its primary function? Why is it so vital?
The IRS does not inherently know that your $7,500 contribution was non-deductible. They see money go into a traditional IRA, and their default assumption is that it is pre-tax unless you tell them otherwise. Form 8606 is how you officially tell them, hey, I already paid tax on this money, this is my basis. It tracks your basis, that is the after-tax money in all of your IRAs.
What is the risk if you forget to file it? Or if your software or accountant misses it?
This is the quiet nightmare scenario. If you fail to file Form 8606, the IRS assumes that money in your IRA has zero basis. That means years down the road when you withdraw it, or even if you just convert it, they will treat it as pre-tax money and tax you on it.
But you already paid tax on it when you earned it.
Exactly. You paid income tax on your earnings, then you put it in the IRA, and if you don't file the form correctly, the IRS will tax you again when that money comes out. It is literal double taxation on the very same dollars. It is a tragedy of paperwork.
Can you fix it if you realize you forgot?
You can. You can file Form 8606 retroactively by amending your tax return. There's technically a $50 penalty for late filing, which is a slap on the wrist compared to double taxation. But the real problem is you have to realize you made the mistake. Many people don't realize it until 20 years later when they retire, and by then the records are gone, and it's a huge mess to fix.
So the takeaway is, file it every single year.
Every year you make a non-deductible contribution or perform a Roth conversion. And again, for married couples, you each file your own separate Form 8606.
I want to zoom out now. We've covered the how, but I want to pressure test the why. Some listeners might be thinking, this sounds like a lot of hassle. Reverse rollovers, Form 8606 settlement periods, all for $7,500 a year. Why don't I just put that money in a taxable brokerage account and call it a day?
It's a very valid question. The administrative squeeze has to be worth the juice. And to understand the juice, we have to talk about tax drag.
Okay, break that down for us with some real math.
A taxable brokerage account leaks money every single year. Let's say you buy a standard S&P 500 index fund. It pays a dividend of roughly, let's say, 1.5% to 2%.
Okay, let's use 2% for easy math. In
a brokerage account, that 2% dividend is taxable in the year you receive it. If you are a high earner, you are paying 20% on qualified dividends, plus the 3.8% net investment income tax, or NIT. So nearly 24% of that dividend just disappears to taxes every year.
That doesn't sound like a huge number on its own.
It adds up. But now consider bond funds, or REITs. Those are often taxed at your ordinary income rate, 37% plus 3.8%. You are losing over 40% of your yield every single year.
It's friction on your returns.
It's drag. It's like trying to run a race while dragging a small anchor. If your portfolio returns 8% gross, but you lose 1% to taxes on dividends and turnover, your net return is really 7%. In a Roth IRA, your net return is 8%.
So let's look at the math over a long horizon. Let's call it the 30-year spread.
Okay. If you invest $7,000 annually, and let's assume an 8% return, in a brokerage account, with that 1% tax drag we talked about, your money is really growing at 7%. In the Roth, it's growing at a pure, unadulterated 8%. Over 30 years, that 1% difference in the compounding is enormous.
How enormous?
We are talking about a difference of potentially $150,000 to $200,000 in the final value just from that 1% annual tax drag.
That is the power of tax-free compounding. It's not just the tax you save today, it's the tax you save on the growth of the growth year after year.
Exactly. And that doesn't even count the exit tax. In a brokerage account, if you sell after 30 years to fund your retirement, you have to pay capital gains tax on all the growth. In a Roth, you sell, you withdraw, you pay zero. The final gap between the two accounts can be hundreds of thousands of dollars.
Well, what about flexibility? That's the big argument for brokerage accounts. They're liquid. If I lose my job or need to buy a house or have a medical emergency, I can sell my brokerage stocks tomorrow and have the cash. Is the Roth locked up?
This is the single biggest misconception that scares people away from this strategy. People think Roth money is locked in a vault until age 59 and a half, but Roth contributions are liquid.
Explain that distinction. It's critical.
The IRS has an ordering rule. The money that comes out of your Roth IRA first is always your contributions. If you contribute $7,500 this year and $7,500 next year, you have put in a total of $15,000 of principal. You can withdraw that $15,000 of principal at any time for any reason, completely tax-free and penalty-free.
Even if I'm only 35 years old?
Even if you are 35. You can treat the sum of your Roth contributions as a backup emergency fund. It's only the earnings, the growth on top of the $15,000 that are generally locked until age 59.5.
That is a critical distinction. So if I have a true emergency, I can raid the Roth for the principal amount I put in without the IRS penalizing me.
Exactly. So you get the liquidity profile of a brokerage account, at least for the principal, but the tax shelter of a retirement account for all the growth. It really is the best of both worlds.
Let's talk about the end game. Estate planning. You've called this estate planning alpha.
This is where the Roth truly shines, especially if you plan to leave money to your children or other heirs.
Okay, but if I leave a brokerage account, my kids get a step up in basis. All the capital gains taxes are wiped out at my death. That sounds pretty good.
It is good. It's a great feature of the tax code. But the Roth is often better. If you die with a Roth IRA, your heirs inherit it completely tax-free. And under the current 10-year rule from the Secure Act, they can keep that money in the inherited Roth for another full decade.
So it can continue to grow tax-free for another 10 years after I die?
Yes. Imagine you build up and leave a $1 million Roth IRA. Your heirs can let that grow, potentially doubling to $2 million over the next 10 years, completely tax-free, and then withdraw the entire $2 million tax-free.
Compare that to inheriting a traditional IRA.
It's night and day. If you leave a $1 million traditional IRA, they also have to withdraw it within 10 years. But every single dollar they take out is taxable as ordinary income. If your kids are in their 40s or 50s, their peak earning years, that inheritance gets stacked right on top of their salary. It could be taxed at 37% or higher. You're effectively leaving a giant tax bomb to your children. The Roth disarms that bomb.
That leads to another key benefit, asset location. We touched on this with the tax drag, but let's be more specific. What kind of investments should you prioritize putting inside the Roth?
You want to put your highest growth, most tax-inefficient assets in the Roth. This is where you generate tax alpha.
Give me a specific ticker or an asset class as an example.
REITs, real estate investment trusts. They can yield 4%, 5%, sometimes more, but those dividends are almost always non-qualified, meaning they're taxed as ordinary income. They are terrible to hold in a brokerage account. You put them in the Roth, and that 5% yield compounds tax-free.
Or high turnover active funds, maybe.
Perfect example. Or speculative, aggressive growth stocks. Or even crypto assets that might explode in value. You want that explosion to happen inside the blast shield of the Roth.
If you buy Bitcoin in a Roth and it goes to the moon, the IRS gets zero. If you buy it in a brokerage account, they are your silent partner in all the profit.
Exactly right.
And one more niche, but really important benefit for those planning ahead, Medicare IRMA.
This is for listeners who are approaching age 65. IRMA stands for Income-Related Monthly Adjustment Amount. It's basically a surcharge on your Medicare Part B and Part D premiums if you're a high-income retiree.
It's a tax on having a high income in retirement.
That's what it is. And it is based on your adjusted gross income, or AGI. Traditional IRA withdrawals, 401k withdrawals, pension payments, they all increase your AGI. They can push you into higher IRMA tiers, costing you thousands of dollars a year in extra premiums.
And Roth withdrawals.
Roth withdrawals do not count toward your AGI. They are invisible to the IRMAA calculation. Using a backdoor Roth strategy now creates what we call a stealth income source in retirement. You can pull $100,000 from your Roth to buy a boat, and your Medicare premiums don't budge an inch.
It's an insurance policy against future healthcare costs.
That is a great way to put it, a very powerful tool for retirement income planning.
We mentioned the mega backdoor Roth earlier. Let's just clarify that briefly for the advanced listeners because people do mix these two strategies up.
The mega backdoor Roth is the big brother. The regular backdoor Roth is available to pretty much anyone with earned income and an IRA. The mega backdoor is entirely dependent on your specific 401k plan at work.
How does it work in a nutshell?
Some 401k plans allow for after-tax contributions above the standard employee deferral limit, which is $24,500 for 2026. The total limit for all 401k additions in 2026 is $72,000.
So if I put in my $24,500 and my employer puts in, say, a $10,000 match, that's $34,500. There is still a big gap up to that $72,000 total limit.
Right. That gap is about $37,500. If your plan allows it, you can contribute to fill that gap with your own after-tax dollars, and then immediately convert those after-tax dollars to Roth within the plan.
So you could effectively get an extra $30,000 or more into a Roth account every single year.
Yes, it absolutely dwarfs the standard backdoor Roth. But you have to read your plan document very carefully or call HR. If your plan doesn't allow both after-tax contributions, which are different from Roth contributions, and in-plan conversions, then you can't do it.
Another advanced nuance, the spousal strategy.
This is one that gets missed a lot. Even if a spouse does not work and has no earned income, the working spouse can fund a spousal IRA for them.
So a single income household earning, say, $500,000 can still do 2 backdoor Roths.
Yes. The working spouse earns the income, but the tax code allows them to fund an IRA for non-working spouse based on that income. This effectively doubles the household backdoor Roth capacity to $15,000 per year or more if they're over 50. Do not leave that on the table.
Finally, let's talk about timing. We said immediate is best, but what if you do it late in the year, say in December 2026?
It can get a little messy if you split the transaction across tax years. If you make your contribution in December 2026, but you don't get around to converting it until January 2027, you have to report the contribution on your 2026 taxes and then the conversion on your 2027 taxes.
It works, it's legal, but it's more complicated.
It just splits the paperwork across 2 different tax returns. It's confusing.
So the simple advice is, try to keep the contribution and the conversion in the same calendar year.
Ideally, yes. Simplicity is an asset in tax planning. Don't create cross-year reconciliations if you don't absolutely have to.
We have covered a ton of ground here. The limits, the big trap, the fix, the long-term benefits. I want to boil this all down to the single most important action item for our listeners. We call this the one question.
The one question you must ask yourself before you move a single dollar is this: do I have any pre-tax IRA dollars sitting in a traditional, rollover, SEP, or simple IRA anywhere in my name?
And why does that one question matter so much?
Because answering yes to that question turns what should be a tax-free strategy into a taxable event because of the pro-rata rule. But, and this is the important part, answering yes early, before you act, gives you time to execute a reverse rollover to a 401k and save the strategy.
It's the difference between a savvy financial trade and an unexpected tax bill.
Exactly. Check all your accounts, look for old 401k rollovers you might have forgotten about. Find any pre-tax money before the IRS finds it for you in their pro-rata calculation.
Let's wrap this up with the key takeaways.
Okay, takeaway 1. Income limits are a mirage for this strategy. The backdoor Roth allows high earners to contribute $7,500 or more annually to a tax-free bucket. Do not let the front door phase-out stop you from investigating this.
Takeaway 2.
The pro-rata rule is the enemy. You must aggregate all your IRAs, traditional, SEP, simple to see if you are exposed. If you are, clear the deck by moving that pre-tax money to a 401k or a solo 401k before you do anything else.
And takeaway 3.
Form 8606 is not optional. It is the only thing standing between you and double taxation. File it every single year you contribute non-deductible funds or perform a conversion.
This strategy is an incredibly powerful tool in the high net worth toolkit. It requires precision and attention to detail, but the long-term compounding of tax-free capital is almost always worth the effort.
And a final thought. If you have the cash flow to save beyond your 401k, the backdoor Roth is not just another savings account. It is an insurance policy against future tax hikes.
This has been Talk Tickers. No advice, just the mechanics. See you on the desk.